All right, everybody, thanks for stopping by. This is Mark again, and I have got a great video for you today. It's about credit. Credit 101. How to get it, how to fix it or repair it, how to maintain it, and how to use it as passive income. I go in on Monday nights to a Florida prison, and I teach these classes to the men who are still inside. The first class we covered getting your mind right. Second class was raising your personal standards. Third class was improving your personal relationships. And then we went over employment solutions for ex-felons. All of those videos you can find elsewhere on my channel. But today is about credit. And it was my 13th day going back in. And there's a few things about credit that y'all should know. Credit scores determine whether or not you get loans and at what rate. Credit can be a powerful tool in achieving important financial goals. It allows you to make large purchases such as a home, a business, or vehicle or equipment purchases that you would otherwise not be able to afford if you had to pay cash. It can also be advantageous when people in your life do background checks on you, such as for home rentals, insurance, and high-value jobs. So before I get any further, I want to explain this. For people who don't have felonies on their record, credit is important because you have more purchasing power with an 800 credit score than you do with 100 grand cash. 100 grand cash is only going to purchase up to 100 grand worth of value. But if you have an 800 credit score, you can sign your name up to 250,000, up to 500,000. Long as you got the income to back it up, they're going to approve your loan. So you have to understand that good credit, in many instances, is more valuable than cash. So therefore, it's important to put yourself in a position in life where you have that to start with. If you somebody who has a felony on their record, it's really important to have good credit. The reason why it is especially important for ex-felons is because so much of your life is going to be determined by a background check. And you can't do anything about the criminal charges that are going to show up on a background check. But say, for example, if you're trying to rent a house, right? They're going to do a background check. If you've got the money and your score is 800, that's 2 of the 3 that you have. The only obstacle you're now facing is your background check as far as criminal record. And a lot of times they only go back 5 years, 7 years, 10 years, something like that. So if you can put yourself in a position to have 2 out of the 3 that you pass, you have a much better chance than if you have a mark on your record and a poor credit score. Now, 2 out of the 3 is working against you. That's a completely different situation than 2 out of the 3 working for you. A lot of people in society can be forgiving, can be understanding of a criminal record, especially if it was a long time ago, if you have good credit. But if you don't have good credit, you just make life increasingly more difficult for yourself. So you want to be sure and stay to all the way through this video because I'm going over a lot of great information here. So I'm going to tell you 2 stories in this video. I'm going to tell you a story about my buddy named Nick, who had great credit and used it as passive income. And I'm going to tell you a personal story about me and how I got started on my credit journey and how I realized that I needed to raise my score. So it starts like this. Okay, my buddy Nick had a credit score north of 800. I don't know exactly what it was, 820, 840, 850, something like that, but he had great credit. And he had a friend of his who owned a car lot, right? A new car lot. And because they were friends, he let him buy a new car, at pretty much cost. So my buddy Nick went down there. I think he gave him a couple grand down, and he put the rest of the car on a 0% interest credit card. Now, I'm going to stop right there and let you know, if you have bad credit, you're not going to get a 0% interest credit card. You're going to get a high interest credit card. It's called predatory lending or subprime lenders. So if you're in that category, you don't get these kind of benefits. But he's not in that category. He had prime credit. So he puts this purchase on a 0% interest credit card that gave him cash back rewards. So he got cash back. I don't know what it was, maybe $3,500, something like that. He put like 20 grand on a card. So not only did he not have interest for a period of time on that card, which was like a year, but he also got money back, like $500 or something like that. At the end of the year, the trial period on this credit card, 0% interest, he called him up and he negotiated a second year at 0% interest. When you have good credit, you could do stuff like that. So he went 2 years with no interest on his car payment. And at the end of the 2 years, he signed up for another credit card at 0% interest and transferred his balance from the first card to the second card. He went 3 years paying on this card at 0% interest. It could be said that all of that interest money he wasn't paying actually went in his pocket as passive income. Unfortunately, my story was a little bit different than that. My story, which I'll get to here in a little bit, you'll see a big difference between his experience buying a car and my experience buying a car. But the first thing you have to understand in Credit 101 is how credit works and how credit lenders work. See, lenders compete for your business, just like any other business out there, okay? The better your credit, the sweeter they must make their deals or their promotions in order to entice you. Because if you have good credit, say, and I'll get into what the credit scores are in a minute, but if you have good credit, then everybody will loan to you. If everybody will loan to you, then the credit card companies have to offer you sweet deals in order for you to choose them. So that's where you get your cash back offers. That's where you get your airline miles. That's where you get all these perks that credit card companies offer their customers. The worse your credit is, the fewer options you have. If you have bad credit, then the pool of lenders who are willing to lend to you becomes increasingly smaller. And the less options you have, the less perks they have to offer you, because there's nobody out there who's willing to extend you credit except this 1, 2, or 3 people. And instead of offering you sweet deals that are to your advantage, they now offer deals that are not sweet, that are to your disadvantage, and you don't have a choice because it's them or nobody. That's the position you put yourself in when you have bad credit. So a good rule of thumb to remember is this: the less it looks like you need credit, the more of it is going to be offered to you. The more it looks like you need credit, the less of it that's going to be offered to you. So this is what I mean. If you have 3 credit cards and each one of them has a $1,000 limit, and you have all 3 of them maxed out, and you apply for another credit card, it looks like you need credit. You've got 3 cards, they're all maxed out, and you're asking for more. Your chances of getting another credit card with a $1,000 limit at good interest rates are, I won't say they're zero, but they're very low. However, because it looks like you need credit. However, if you have 3 cards with a $1,000 limit and you have 2 of them empty and one of them has $100 on it, you have $2,900 available to you. Now you ask for a card, looks completely different. It looks like you don't need credit. So if you don't need it and your money situation is fine and your cash flow is uninterrupted and plentiful, well, then there's going to be plenty of people who are willing to offer you more credit. So your responsibility is to make sure you don't need credit. You don't put yourself in a situation where it looks to a lender like you need their help. The less you need a lender's help, the more lending you can get. The more you need a lender's help, the less lending you're going to be able to get. That's a rule of thumb. And all throughout this lesson, this video today, I want you to keep that in mind. You may say, now, Mark, what's a good credit score? What's a bad credit score? There's 2 main scoring factors. You have the FICO credit score and you have your Vantage credit score. The FICO credit score is really your official one. And if you drill down deep, they have lots of FICO scores. A FICO score 8 is the most common, FICO score 9, FICO score, on and on and on. But generally speaking, people, when they're talking about your credit score, they're talking about your FICO score. And if you're buying a car, getting a credit card, something like that, it's generally FICO score 8. The Vantage credit score is a whole nother system, and that's usually where you get your free scores from. So say if you go on Credit Karma, that's a Vantage score. Usually if your score is free, it's a Vantage score. It's similar to a FICO score, the way it's calculated, but it's not exactly the same. So you have to understand that. And credit scores are constantly changing depending on the information that's being provided to the credit bureau from the lender. So just because you have one score today, that doesn't necessarily mean by the end of the week your score is going to be the same. It may or may not change depending on your financial information. But in general, a 300 to a 579 is bad in a FICO range, or 300 to 600 and a Vantage score is bad. Fair is 580 to 669 in a FICO, or 601 to 660 in a Vantage. Good, a good score is 670 to 799 in a FICO, or 661 to 780 in a Vantage. And an excellent score on a FICO is 800 to 850, and in a Vantage, it's 781 to 850. So there's a small difference between the scores, but now at least you know when I say good credit, bad credit, whatever, you know kind of what we're talking about here. Generally speaking, 670 and above is a good position to be in. The higher the number is, the better interest rates you're going to get, the better position you're in. But usually 670 and above, most people will lend to you. Below 500, you're in trouble. It's going to be very difficult to get a loan. It's going to be very difficult to get any sort of consideration. And if you do, it's going to be at terms that are not advantageous to you. How a credit score is calculated. Your payment history is 35% of your score. Do you make your payments on time? How long have you been making your payments on time? How many payments have you made on time, not missed or not been late? That's the most important factor. The second most important factor is amounts owed. That's 30% of your score. How much do you owe? It's also referred to as debt to income ratio. How much of your income is already obligated out to past debts? The third most important is length of credit, your credit history. How long have you been using credit? If you've just started on your credit building journey and you have had a credit card for a year, that's not going to be as strong as a profile as if you've been using credit for 20 years. The longer you've had credit, usually the better your credit score will be if you make your payments. New accounts for 10% of your score. How long has it been since your last account was open? Now, the newer your account is, the lower your score is going to be. Because remember the rule of thumb. If you've just applied for credit and received it, say in the instance of a credit card, if you just applied for a new credit card and received it, that looks like you need credit. Otherwise, why would you apply for the card if you didn't need it? So if it looks like you need credit, that's a hit against you. It's a necessary evil if you're trying to establish credit, but it's still a mark against you. If your newest account is several years old, then it doesn't look like you need credit. Also, the length of your credit history is an average. So if you have long-standing credit cards or long-standing trade accounts, and then you get a new one, now that new one gets averaged in with the length of the old ones, and it brings your entire credit profile down. So you don't want to keep applying for cards. You don't want to do that. You want to let your credit age. The longer you've had credit, the longer it's been since you've opened up a new account, the less it looks like you need credit, and the better your score will be. And types of credit, like your mix, is also 10% of your score. That's a mix of credit. Do you have credit cards? Do you have installment loans? Do you have a mortgage? Different types of credit will also factor into your score. How do you get a credit score? A credit score is a calculation of good borrowing habits as well as negative borrowing habits. So the idea is to minimize the negative information being reported and to increase the positive information being reported. Also, you need to have an understanding of your billing cycles and statement dates and reporting policies. Okay, so now that we've covered the basics, I'm going to tell you my story. I told you Nick's story about how he was able to go get a car with very little money down, paid 0% interest for 3 years, and made money on the deal. Not only did he make money because he pocketed all of his interest, but he made money on the deal because he put it on a cashback card. Okay, so we see that as an example. When it first came to my attention that I needed to work on my credit, I was trying to buy a car. I had a Chevy Avalanche that I owed $6,000 on. I picked up and sold scrap metal out of this vehicle, so I wore it out. It was beat up, it was banged up. I didn't want to drive it anymore. I didn't want it. I was done with it, and I decided I was going to trade it in. Well, I had 3 things working against me. One, I was upside down. I had negative equity in the vehicle. I owed $6,000 on it, and it was only worth generously $1,500. It was really probably worth $1,000. So that meant I was between $4,500 and $5,000 upside down in the vehicle. I owed more than it was worth. That was the first thing. The second thing was I was broke. I didn't have any money. I didn't have any money for a down payment. I was upside down in my bank account too. That's the second thing. The third thing is I had a poor credit score. I don't remember exactly what it was, but it was sub 600. I was probably 540, 530, something like that. It wasn't good. And I spent 30 days trying to trade my vehicle in. And I was told no every place that I went. I remember I started at the beginning of March. And I wrote about this in my book, Really Good at Barely Getting By. If anybody would like to pick that book up, I'll put a link in the description. I was in this impossible situation. But as I went from car lot to car lot to car lot, trying to get a new vehicle, I learned some things. One of the things I learned was it's easier to get a bank loan on a new car than it is a used car. So I quit going to used car lots and I started going to new car lots. The other factor is this: you can get a rebate on a new car. There's no rebates available on used cars. And I needed a rebate in order to eat up the negative equity that was in my Avalanche. So March 31st, 2016, I went into a Toyota dealership and I sat down with a salesman and we talked about my situation. And it took 9 hours. 9 hours I was there at the car lot, but I drove off with a brand new 2016 Toyota Corolla that I still own today. But it was a horrible deal. And what they did was this: the car was on the lot for sale for $18,000. It was normally 22, 23, something like that, but it was on sale for 18. They finally agreed to do the deal, and they said they weren't going to sell it to me at 18 grand. They were going to sell it to me at the full price of 22, 23, whatever it was, so that they could make up the difference in the negative equity in my trade-in, which was the Avalanche. So the first deal was I had to pay more money for the car. I paid like 23 grand for a car they had on sale for 18 grand. The next point about buying a new car instead of a used car is there was a cap on the interest. At that point, 2016, they were capped on how much interest they could charge you. It was 16.9. Now, I understand that's high, but that's the most they were legally able to charge me. I did get a little bit of a break because it was a new car and there was a cap, but they charged me the most amount, 16.9. The next thing I did, I had put $1,000 down, but at that time I didn't even have $1,000. But I was waiting on my tax return, so I wrote them a check and they held it for 30 days. I wrote them a check for $1,000. That was no good at the time I wrote it, but they held it for 30 days. And within that 30-day time period, my tax return check had came back and I was able to cover the check and I was okay. So I drove out of there with a new car with $545 a month for the next 6 years as a payment. It was a horrible deal. I got, by the time they did the tax and the title and the dealer's fees, I borrowed $25,000 on a car that was for sale for $18,000. And by the time I ended up paying that car off, I had paid over $40,000. So understand the difference between the good credit and the bad credit. My buddy was able to get a car for about the same price, a few thousand down, no interest. He made money on the deal in two different ways. And the difference was our credit scores. So you see how disadvantageous it can be to have a bad credit score or not to have a good credit score. It doesn't even have to be bad. If you don't have a credit score at all, you're still in the same situation. So if you want life to treat you better, then raise your credit score. So it was on that day that I decided I needed to start working on my credit score. And the first thing I did, I wanted to remove some negative. The Avalanche, I had 5 late payments on. And the Toyota dealership had just bought it. I knew they were about to pay it off. And I called my lender and I said, hey, listen, if I pay this car off in the next week, when you make your final report to the credit bureau, would you be willing to change those late payments, those 5 late payments, to current? Could we make that deal? To my surprise, they agreed. Now, some of your bigger finance companies and some of your bigger banks aren't going to do this, but it's an example of trying to negotiate, and it's an example of trying to get negative reporting off of your credit report. So he agreed. And in the next week, 10 days, when they got the check from the Toyota, he kept his word. Those 5 late payments fell off of my credit report. And I also had a paid off loan. My credit score went up a little bit. It also went down some because I got a new loan. But either way, I was successful in getting some of the negative on my credit report removed. So you can do this by doing disputes, by negotiating. The next thing that I did is I had to start building positive credit history. I don't think I had any credit cards at that time. As I mentioned, I was waiting on a tax return. So when I got the tax return, I don't remember what it was, like $5,000, something like that. I gave $1,000 to the dealership. And then I took $3,000 and I went down to Wells Fargo. It was my bank at the time. I went down and I gave them $3,000 down on a secured credit card. Instantly, my score shot up like 90 points just because I had a $3,000 credit card at that time with a 0 balance. It was a quality card from a quality lender, Wells Fargo. And it was a respectable amount. It was $3,000. The fact that it was secured really didn't matter. My score shot up almost 100 points. So I removed some negative and I replaced it with some positive, and my score went up. Next thing that happened was I became an authorized user. As I said, my buddy Nick had good credit, and he had this Discover card that he had had for a few years, and it had a $20,000 limit on it. He never used this card, and if he did use this card, he only put a couple $100 on it, and then he'd pay it off at the end of the month. He used it like to pay a light bill or something like that. He had a great payment history on it, and he added me as a user. Still to this day, if you pull my credit, you see where I have a long history with Discover at a $20,000 limit with 0 balance. That's because he made me an authorized user and I inherited his credit history. So if you have a family member or a friend who has good credit and good payment history, if they make you an authorized user, you inherit all of that credit history. It's unearned favor. You did nothing to earn it, but you inherit their good credit history on that trade line. Now, instead of sitting at 550, wherever I was at, now I'm pushing 670. And this happened in the course of about 30 days. It shot right up. Once I hit 670, I was then able to apply for some other cards. And that's another trick. The more credit you have available to you that you're not using, the more your score will go up. So if you have $1,000 card and you have $20 on it, you have $980 available to you, that's a good thing. But if you have $5,000 available to you and you're only using 20 bucks of it, that's an even better thing. So something I did to help build my score is I was applying for cards. Now it is true, every time you apply, you take a hit, but the hit is minor. And if you apply for your cards all at one time, as opposed to I'll apply for one now, 6 months later, a year later, I'll apply for another one, a year later, I'll apply for another one. You keep your length of credit history negative because you're always getting a new card, which is always bringing your length of credit history down. But if you go ahead, you take the bath, you do it all at one time. I took a 3-month period and I applied for all these cards in this 3-month period. My score went way up because of the available credit. It kept increasing. So my score kept increasing. And then I stopped. After you get where you want to be, as far as your credit cards and that kind of thing, you want to stop. You don't want to keep applying because it's an average. So then after I got my score up where I wanted it to be, I still wanted to increase the credit I had available to me, but I didn't want to apply for more counts. So how did I do that? I began to call every 6 months and ask for a credit increase. A credit increase will increase your limit that you're able to spend, but it don't count as a new account. So therefore you get more credit available to you, but you don't take the hits for applying for new accounts. So I knew when the 6-month mark was on every card I had, and I did this like a strategy. I would call and I would apply. In some instances, I was given a credit increase. In some instances, I wasn't. But I kept trying every 6 months. And there's a little trick. If you're trying to increase your credit or if you're trying to get a new card, there's a little trick called the shopping cart trick. And I'll explain it to you. The standards, the criteria for being approved for a new credit card account or increasing your limit is lowered at the point of purchase. So if you're just sitting at home and you fill out a credit card application and you send it in, the criteria for approval is a little higher. But if you're at the store at the point of purchase and you apply, then it's a little lower. So what I would do, I remember one time I had a $6,000 limit on a Macy's credit card and I wanted to increase it. So I applied for a credit increase. They denied me. And about a week later, I went online and I bought 2 really nice watches. The watches were probably $3,000 a piece, maybe $3,500 a piece, something like that. The total exceeded my credit limit. So I put them in my shopping cart and I called for authorization. And I told them I was trying to make this purchase and I would like them to raise my credit limit. They looked at my history, they looked at the purchase, and they raised me up to like $8,000 or something like that. I think my total purchase price was $7,000 and they raised me up to $8,000. After they raised me up to $8,000, I got off the phone with them. I took the watches out of my shopping cart. I never bought them, but I had successfully raised my available credit. Another time, I had applied for a Best Buy card on my own. I was denied. And a few weeks later, I was in a Best Buy store and I wanted to buy a computer. The computer was like $1,500. It was all in one, big monitor, all that type. And I applied at the point of purchase. At the point of purchase, they approved me for $2,000. So I bought that computer. A month later or so, I got a tax return back and I paid that off. And I still use that computer to this day. But my point is this. Here's a trick for you. Whether you want to increase your available credit, or whether you want to get a new account, use the shopping cart. The shopping cart, the point of purchase application, has a lower barrier of approval than not. So I did the shopping cart a few times. I brought my score up a little bit more, and that's something that you can do as well. So now that you get the credit, how do you manage it? It does you no good to get a new credit card account and then go max it out. That's going to tank your score. And the objective here is to raise it. So how do you keep it high? I would say to only use 10 to 30% of the available credit on that trade line. You don't want to go over 30%. So if you have a credit card with a $1,000 limit, never, under any circumstances, charge more than $300 on there. However, if you can keep it below that, your score is going to be even higher. The ideal credit utilization is 10 to 15%. So if you had a $1,000 card, typically you only want to put $100, $150 on there, no more than that. If you did go over that, stop it at $300. Period. Don't go over 30%. Once you go over 30%, it begins to drop your score. Your score begins to lower. I would also suggest, while you're going through the process of applying for credit cards, apply for one or two cards that you're not going to use. Let me give you an example. I refer to these as buoys. I have a K Jewelers card. I don't buy a lot of jewelry, but once a year, on our anniversary, I'll go in and I'll buy my wife a piece of jewelry for our anniversary, and I'll put it on this card. All throughout the rest of the year, I don't use this card. But the available credit that I have on it keeps my score buoyed, like a bobber, like a buoy, something like that. It holds my score up. So if I use a little more than I'm supposed to on another card, the low credit card utilization on this card will help pull my score up. So an example might be, fellas, you might want to get a Victoria's Secret card. You're not going to be in there buying bras and panties every day. You might do that once in a while for your girl or something like that. But in general, that's not a card you're going to use. Ladies, maybe you might get a tool card or a Home Depot card or something like that. Something you're not generally going to use. If you get yourself one or two of those types of cards that you never use, that helps to counteract the heavy usage of other cards. So if you don't have a buoy card, if you just have Visas and MasterCards that you use heavily, your score is going to tank. But if you have a couple of these buoy cards that work to hold your score up, even when you go a little heavy on other cards, it's going to work to your benefit. So get yourself a couple buoy cards. You also want to time your purchases. So let me explain this, okay? This might get a little complicated, so listen here. If you understand when your billing date and your cycle date and all that is, let's just say that you want to make a purchase, and it's a large purchase. Let's say you have a $1,000 card. It's a MasterCard, let's say. And you're going to put $800 on it. Now that goes against the 30% utilization and all that. I understand that. But let's just say it's something you have to have. Maybe it's a tool, maybe it's a bill you're paying off, or whatever it is, it's important to you and you have to use this card. So there's a way to do that. If the billing on your card ends on the 10th of the month and they report to the credit bureau on the 12th of the month, make your purchase after the 10th or after the 12th. So say, for example, you have a $1,000 card. It reports to the credit bureau on the 12th of the month. The billing cycle ends on the 10th. On the 10th, you have $1,000 available to you on the card. If you make that purchase of $800 on the 9th of the month, your cycle's going to end on the 10th, and they're going to report on the 12th you've used $800 of your $1,000 available. You're going to see the next week your score is going to drop like a rock. But if you wait till the 13th to make that purchase, the billing cycle ends on the 10th, they report on the 12th, you make your $800 purchase on the 13th, your credit score does not drop. You got a whole nother month to try and pay that $800 down before your billing cycle ends on the 10th of the next month, and they report on the 12th of the next month. You give yourself 30 days to break the rules, so to speak, of credit utilization. You give yourself 30 days to break the rule, and in most cases, it doesn't even accrue interest during that time. So if you can pay that off, maybe you're just making this purchase, and on your next paycheck you're going to pay it off, or you're waiting on a tax return check or something like that, like I did with the computer. That's how you can cheat the system, and you can spend more than you're supposed to on a card and not have it affect you in a negative manner. Now, if the 10th and the 12th of the next month come around and you still owe $800, bloop, your score is going to drop. So you have to move strategically, and you need to know when your cycle date ends and when your reporting date is. And then you make your purchases after that date, not before that date. So, how do we profit from credit? How do we use it as passive income? As I already explained, once you have good credit, then the lenders begin to compete for your business. Once they compete for your business, they offer you cashback rewards. So my buddy Nick had this card that had cashback rewards, and he would pay all of his monthly utilities. He would pay his electric, his water, his phone bill, all the stuff he had to pay every month anyway. He would pay on a cashback credit card. At the end of the month, he would pay that card off. So, thereby, he would make money from paying his bills. If the total of his bills ended up being $1,000 a month for everything, he would get a percentage of that cash back. So he lowered his bills, improved his credit score, and got paid to do it. You can borrow money for free if you have a good credit score, just like my buddy Nick did with his 0% interest. You get these 0% interest cards, their introductory offers or whatever. You can borrow money on that at no interest. The interest you're not paying is passive income that goes right into your wallet. Things cost less when you have good credit. Things cost more when you do not have good credit. Also, when you have good credit, you don't have to use your own money. Say you have great credit and you want to buy an investment property. You can go to the bank. You can borrow the money to buy a duplex, let's say. You use the bank's money to buy the duplex. Then you live in one side. You rent the other side out. You use the rent money to pay the mortgage. And you collect the equity. By the time it's said and done, you would have bought that a duplex and it would have cost you nothing. But you bought it with the bank's money and you use rent money from your tenants to pay the bank back. You get a free asset as well as a place to live. Not only are you using other people's money to buy an asset to increase your wealth, but for the life of that loan, and as long as you have renters, you're living for free. And you can do that with a duplex, you can do that with a triplex, you can do that with a fourplex. Sky's the limit. If you can think of it, you can more than likely do it if you have good credit. So that's credit 101. I brought that to the guys in the joint. A lot of them were very interested to hear that. There is one thing that I didn't cover when I was speaking about authorized users. Let's go back a little bit. Let's say you don't have a friend or a family member who will allow you to be an authorized user. Or let's say you don't have a friend or a family member who has good enough credit or a trade line that you want to be an authorized user on one of those accounts. What can you do? They sell trade lines online. People with good credit, with good long-standing payment history, will sell you the opportunity to be on their trade line. Prices vary depending on how strong the trade line is. But if you have somebody with a credit card that's been open for 15 years, perfect payment history, maybe the credit limit is $20,000 and they have $100 on it, or they have $0 on it, it's fully open, and they've had this card open for 15 years, that's a good strong trade line. You might pay them $800, $1,000, and how it works is they add you as an authorized user, you inherit their credit history, and they will usually leave you on for 2 billing cycles, and then they take you off. So that's another way to become an authorized user. But by the same token, if you put yourself in that position, you can now sell your trade line and you can make money off of having a good credit score and a good payment history. So there's more to go into with credit, but this is credit 101. It's not 201 or 301. If it has helped you out, if you've got something from it, if you have a credit tip of your own, I appreciate if you get in the comments and you leave that below. And let's talk about this. In the meantime, up your averages, and thanks for watching.